2023 can be marked by many things, but in general, it's been all about technology and central bank liquidity. Today, we discuss both of these topics along with the idea of clusters. What happens when we see only a few stocks running the market, low breadth, and a cluster breakout? Let's go through it all and what it means for you as an investor, trader, or even scalper. Well, welcome back everyone to the Daily Show where we discuss stocks, commodities, and cryptos. We've got the latest news, the key levels, the macro data, and of course, all of the hottest charts coming your way. But let's begin with 4 reasons why the stock market keeps on climbing the wall of worry. Now, we have a lot of reasons to be bearish in markets when you think about the macro side of things. But what's going on right now is most likely the pain trade continuing to be higher. More people are shorting, but at the same time, we're seeing some big gamma squeeze breakouts. Recently, we've had Google, and as of last week, we started to see Tesla start to play the game, and it blew out massively over the last 24 hours. We'll look at that later on. We've also got central bank liquidity to blame. On one side, they're saying we're tapering, and then we see Silicon Valley Bank, Credit Suisse, all of those others, and instantly the Fed come back in with the big bazooka. Now, what happens? It generally leads to asset appreciation. However, that has been on the decline recently, and the markets are pushing some storylines we've seen before. Huge rallies based on maybe something that is disconnected from reality. And we'll look at that a little bit later on. Fears of imminent recession are dashed. We'll take a look at our number one. We're going to get a call of a recession indicator. We'll look at that later on today's video. But in general, we can also say that there was a recession in 2022. They just changed the rules behind it, and that made it so that we avoided it. Did we see the recession? Are we going to see a double dip? My guess is we'll see a double dip recession with, that having some ramifications on things like ERP and other kind of concepts in the markets. And the last one is, of course, the AI craze. We started with Microsoft and Nvidia, my favorite stock and a great one here. Then in about 2 weeks ago, we started to see Google breaking out, and that so far has been in the squeeze. Right now, we're starting to see Tesla do something very similar, and we'll look at that later. So let's go back over to the cluster. Here are some clustered stocks. If we go back through history, we can start to get a bit of an idea when this happens. Now, a lot of people know that generally technology leads us out of recessions or out of bear markets. So far, technology has led, but the other sectors are not coming. XLY, very laggy, started to turn a little bit a few weeks ago and starting to come up. Semiconductors also lagging behind, except for things like Nvidia. Again, we've seen some breakouts. Are they real? We'll have to figure that out as well. And then we get the other sectors moving around. But it is a tale of basically 3 markets. We saw a Dow Transportation Index and Dow 5-day down about a week and a bit ago. And what that tended to lead into was a squeeze, a final squeeze. Funnily enough, it's exactly what we're seeing. In both 2011 cases and 2020 cases before larger pullbacks, we saw a squeeze of 2.6%, and I think it was around 9%. Now, we're well on track to do the 2.6. We've already pretty much seen that. The 9, will we get even higher? We'll look at the options to figure that out. Let's have a look at some of the stats, though, around these. And this isn't, I know I said I'd bring up usually only 30 and 40% stats, but I just wanted to show you what happens around here. And it's not so much that there are significant gains or big percentages. Remember, the market is generally 68% bullish. I always state that 68% bullish. To short it is more difficult. That's why I always suggest if you're going to short, you have to play the options game. You've got to allow yourself time. It's not easy. Let's go over here though. 5.7% drawdown or 9% drawdown maxes. So will there be a buy the dip scenario? We'll look at a chart a little later that shows us something around there. What about the tech S&P ratio after a multi-week cluster of 1-year lows and then 1-year highs? Well, when we get reads like this, again, it's pretty similar. A lot of coin flipping that goes on over the next 6 months. And it's in line with what a lot of people are starting to think of. Have these markets run a little bit too hot? Are we getting away from reality in terms of the tale of 2 markets? And also, how do we ride it and then potentially not get stuck if it does go bad? Or recognize the rotation? Well, we'll talk about that later on. Let's have a look at bullish sentiment surveys. Now, we've always used this along with other reasons to state that, of course, basically people have been convinced of a certain session. We still see too many bears. Take a look at this AAII bullish sentiment 52-week average. It's in the ground still. We need to see that rise back up. And it's very neutral right now. I think it's sitting about 35, 37% neutral. But in general, there are not enough bulls on these sentiment surveys. It's the same thing here with the Yale US 1-year investor confidence, still very low. Unfortunately, you do generally need to see those spike back up. We are monitoring that. We release it every Friday in terms of just getting the data. So definitely stick around on the channel because that's going to be a very good tell. We got it super hard in February. No one believed it. We got that sell-off. Unfortunately, straight after that, while all the banks started going down, central bankers went, fix the hole, and now we are where we are. Let's have a look at S&P 500 pre-election years over the long term. If we take a look here, we've got first year pre-election years, we've got pre-election after midterm bears, and then of course we've got 2023 versus the aggregate. What is clear is that there is a huge component of very sidewaysy kangaroo, slightly grinding up action that tends to happen. We also tend to see a fairly interesting slowdown that happens more around the middle of July. Now, of course, we're not even close to that yet. We're sitting here in June. So will we have a little bit more of a run? Well, my thought process is kind of something like this. Maybe a little run down, base off, probably come back, and then possibly drop, base that, and then probably run back up. Now, how big is this drop? Yeah, that's the question we want to ask ourselves. But I do think that we need to always remain the same way that we do. As an investor, I always remain the same way. If it's not driven by retail property, that is residential property, I'm not that scared because central bankers will always come in the way they have. They come and flood the market. Pension funds in the UK, I've always said the same thing. As a middle-term investor, if I'm looking at the markets right now, the risk reward seems off unless I'm going into certain sectors that I think are going to get rotated to. Technology, though, that's a squeeze. We've seen this play out before. Let's update dumb money versus smart money. We've used this chart. At the moment, it's not giving us too much edge. We're not obviously seeing the huge discrepancies we wish we would see. And we do know that technically, yes, dumb money's rolling this according to this indicator. It's not my indicator, but it does show you here that there is not much edge going on from this. Now, what about buying the dip? Well, we're starting to approach some pretty damning stats towards bears getting their way in markets. Here's one here taken from Carson. We're probably on day 97 at this stage. When we reach day 100, it's a pretty big deal. Now, does that mean we don't get some kind of drawdown? No. I mean, even the stats show you that drawdowns can certainly happen, and they can be in the vicinity of even 10 to upwards of 20% at these kinds of points. However, what is happening here is we've got to be very cautious of not looking at the dip. We know what the central bankers are going to do. And unfortunately, a lot of people have always thought we're going for a hard landing, the whole market's stuffed. I still believe that commercial real estate's a problem. Everybody knows that. Debt ceiling is an issue, sure, whatever. They'll sort that out. And whether that sucks money out of the treasuries, which we'll talk about in another video, and we actually get a hit on that one, it's most likely not going to sustain for too long. So I wouldn't worry. I still think that the risk reward doesn't really make sense in the markets right now. And I'm pretty confident that over the middle term, we will still get a forward PE that is very attractive. The problem is patience. That can be hard. When you're trying to go against the market as well, it can be very hard. So I think day trading still remains good, or sector rotation, which we've been discussing on this channel really for months. Obviously, it's been a big reason why I've shorted metals and energy and those types of sectors. Now, let's move over here to Tesla. I mean, here is the unusual volume. I think you can see the trend here, which I put over on Twitter. This is some wild stuff. Volumes out of control, massive volumes. Look at these calls, 190, 185, 200. They're all stacked for Friday expiration. Let's see what happens over this time. But we're sitting at 188. That's a big reason why they came through. You've got to watch these 0DTE options or these 1 week options at the moment. The market is basically doing a 2021 kind of AMC GME on massive stocks. It's almost like literally a slot show at this stage. So anyway, if you want to follow us over on Twitter. I am sharing those things on the daily. I'll continue to share those 0DTEs. Let's move over to the one indicator that generally tells us a recession is actually going to come versus, or be called very soon, versus the reality of where we are right now. In general, you usually see US 2-year versus 10-year uninvert, or at least 3-month versus 10-year uninvert. That means it goes back underneath 1%. Now, you cannot look at this as anything other than that. If you go back through the history, and I encourage you go and check it out, you'll generally see uninversion, then the recession get called. Remember, it happens when people least expect it. From a swing trader's perspective, and I do stress swing traders' perspective, is it a good time to sell the market? Well, it depends on options. You could do that because of discrepancies, but you'd be mostly guessing. We don't have a turn here on markets just yet, and you can see the SPX. We also know that central bankers in general have been pulling some liquidity. However, the Fed got a little sneaky recently, and with this indicator, you can see they've actually injected while they claim they weren't. So I don't know what they're doing sometimes with some of these things. We are getting a huge divergence though. That red, the deep red here on the Qs and the SPX shows mass divergence. So this is most likely a squeeze. We've seen it play out before, and we have what's called a TD. Basically, we've got almost a TD13 starting to appear, a very rare signal in the markets, often really showing you incredible exhaustion. So we're watching those Qs like a hawk. The NASDAQ is being watched very closely by me right now, especially considering we've got these breakouts. Everyone's excited. Everyone's getting involved. This is the time where you do need to be very good on your risk management. Let's move over to ES. This is a Bollinger Band on ES. And you can see here we're kind of pressing that daily. And really when you press the daily, you often go into a sideways, or you might be able to pull like 1 or 2 more days out, push that Bollinger up, and then often you do come back. Now we'll talk about this pullback, which we did on our daily show, to this key 20 moving average, which is the middle of the Bollinger, if you weren't sure, and the most traded level, plus what we know now was demand. There's a decent chance we go back to that. What happens there might be pretty important. Here's a bit of a chart that I shared in the private community, and I did a bit of a macro look ahead. If you're interested, free 7-day trial, links in the description down below in the link tree. Basically, you have a pretty significant repair level that could happen here on markets. Now, this pulls us back down to the 4140. This is the ES, by the way, and it comes back into this demand zone. Now, we know through here is a very, very heavily traded zone. We've got an anchored VWAP sitting behind it. But realistically, what we're looking for is the market to come down and repair some of these pretty inefficient moves. They're moves that have got almost no volume in them. So when you come down to these levels, that's where you want to see those spikes come back through. If buyers are really going to commit, it's going to be here. If you're a bear in markets and you see this flick, it could be what we call a UTAD or a Wyckoff high, and that is a significant switch in trend. If we go to new lows, if we go underneath here, that's where people do stuff. Now, I've always been a big proponent of scaling positions. Now, I'm not going to say that I haven't got a little short on the markets. Okay, yes, I do. I've done obviously put spreads, and I've done it at 41.50 in terms of the S&P. Now, I've gone 4 months. Why? Because I don't know which time this is going to go off. I'm looking for the signs, just like all of us are. One of the signs I've mentioned recently is skew decline. I want to see this thing get crushed. Crush the skew, guys. That's what we need. The black swan indicator was getting too high. We never see turns while the skew is going up. So we want to see crushing of the skew, S&P and Qs going higher or starting to go sideways, and then we can go back and have a look at April and August. It's a great little indicator for that, going a bit contrarian there, since the VIX is so useless right now. US 100 futures, just wanted to show you here. We went past a TD9, we're at TD10, pretty much 11 now. So it's a significant weekly and daily kind of thing that's going on here. This usually shows you extreme exhaustion of markets. They don't generally hold this well. So yeah, I haven't seen one of these for a while where it's been on the weekly and the daily on the markets for so much period. But you can see here that this went into a big TD9 read. What happened? We got the sell-off. So we are looking very closely at this market in exhaustion. I'll keep updating you on it. US 100, I'm not touching that thing short. I'm not going for it. It's just not worth it until we prove otherwise. We need to see this thing actually give us a turn. Someone big to not be gamma squeezing every single one of these stocks out. I can't believe we're in 2021 style market, but with trillion-dollar companies now. It's the power of the zero DTEs is real over the last couple of weeks, especially. Let's move over to copper. What are we seeing? Weakness, demand destruction. Obviously, the tale of two markets. Keep going down. Well, that's going to be weak overall for many stocks, things like energy, things like metals. Again, markets are very important. If we look at corp bonds saw some rise, but still on a lower high. Generally, I trust the bonds market more. Here's the bonds market implied vol versus the VIX itself. VIX suppression is still there. We saw OPEX last week, which expired some options, but basically we're only given a little bit of room each time. And what I mean by that is we see the options expire. That takes off a lot of hedges, allowing the market theoretically to actually sell this week, because obviously we had all those hedges on. Then what happens though, it looks kind of like this. Then it goes